Hey, good afternoon, everyone. Marty Missouri here, March 14th, 2020. I think I'm going to be doing quite a few videos for you, along with quite a few written blurbs on the blog going forward. Not that we don't do a lot already, but more videos than we've been doing lately. So let me just jump right into it. I want to address this sentiment that we are experiencing or have just experienced one of the greatest buying opportunities of all time. Hearing that from a few clients, a few friends, seeing it among the financial analysts who I might follow on Twitter and other places, certainly in the financial media. You're getting some of that. I think you're probably getting some of the more dire predictions or prognostications. Hopefully they're bringing on both sides. I try to be neither. We try to be neither. We have a methodology. And folks, you have to have a methodology. You can't, well, you can. You can, jump in and buy right here just simply because the market's down. I've seen people who are very popular in the financial space, screaming buy in all caps with exclamation points to follow. All I can gather is that they should buy because, or that people should buy because the market just dropped 27% over the course of a very short period of time. And then, of course, we got that big bounce. If you've been with me at all, you know that before the big bounce, in fact, the day before, I suggested on a video that we are going to get big bounces in this market. If this is truly a bear market, what's going to happen is they're going to bounce and then they're going to fail, and we're going to establish lower and lower and lower highs over the weeks and months to come. If this is just a quick snapback correction like 1998 and to some degree like this in 2018, well, then we're going to come right back to new all-time highs when maybe some things clear up and we get a boatload of stimulus and off to the races once again. I'm open to all possibilities. The latter is right now not my base case, and I want to make sure that you all understand why. Just listened to a very good interview between an analyst who I have a great deal of respect for. He was actually the interviewer this time, and a gentleman, a financial professional in Italy, who is basically in quarantine, like the whole state or the whole country of Italy is at the moment. And he spoke very intelligently about the research he's done on the virus and the impact on the economy and how they're managing and so forth. He said something that's interesting to me, though. He thought that this was going to be the bottom right in here, which was the 2018 bottom right there. And he made suggestions that the economy was in good shape leading into this. And that's where his analysis and mine pretty much leave each other. But not so much that this could be the bottom, but that the economy was in good shape when this began to roll over. So but he did say that they're preparing for worse than that, but that's what he thinks would be the bottom. So we'll see. My best guess is, based on my macro view and my experience in bear markets, is that while this very well could be the bottom, if it is, it's going to be unprecedented stimulus that just continues to be washed into the economy or thrown into the economy at just record pace, enough to hold things up from here. Even central bank buying of stocks and that sort of thing. So, again, I could be wrong, but things aren't good as we sit here today. But I do recognize and appreciate, and even to some degree in my younger days, sympathize with the notion that you should buy the dip simply because it's dipped and it's worked so well over this long period of time. So let's consider that within the context of history. Always a good idea. So we'll start with the last bear market, the one immediately preceding this one, which actually was quite a ways back. It was, the 2008 experience. So what happened there is, we peaked right here in the fall of 2007, and we had, about 11% decline, just a correction at that point over the course of, gosh, about, the next year or so plus. And finally, looked like we found a bottom, jumped 8%, came back down another 16%. Oh, viable dip, we jump in there. And then we jumped up, came down, confirmation. We found support. Uh-oh, we bought. Another reason here. It came bounced off that, the technicians rushed in right there maybe. But it peaked at about a 13.4% advance. Then we came down over the course of quite a few months, 17%. buy the dip? Well, we did, went up 9.35%, turned around, dropped 14, came up 11, dropped 34%, came up 20. I bet a lot of people thought that was the end. Nope, dropped another 27%, came up 27% to here actually. Not yet, came down, call it 30% before finally it bottomed for good in March of 2009. So folks, we had some huge days in here off of these bottoms, absolutely huge. In fact, the big day that we had yesterday was the best one-day return since one of these days back here in 2008. We've had so many since 2008s lately, they're hard to count. But of course, saying that something hasn't happened since 2008 should do anything but instill confidence when you look at the experience of 2008, right? Folks, here's my point. I'm going to continue to make it in this video. Buying the dips may make sense. This could be this one. We just don't know, but I'm going to share with you, you already know this, most of you, what our methodology is for determining whether or not that's a good idea. Before we do that, we'll look at the tech bubble experience. Peak to trough, 50.50%. Initially, 14% decline. My goodness, buy the dip. Look at the huge two-day rally off of that. 10%. Oops, came back down, up, down, up, down. Almost to the last. Almost just made this just your garden variety correction, but not quite. And then, 11%, nice gains, smart to buy the dip, but oops, we turned around and we dropped about 15%. And that was over a relatively short period of time. Huge snapback, boom, 10.2%. Uh-oh, came back down. I'm going to skip a little areas here. 22% decline from there. We're now in bear market territory and it's time to buy, right? Like yesterday. 22% over a really short period of time, just a matter of a few months. Peaked and then came back down for another 28% decline. Huge rally, up 24%. Finally rolled over, way back up in here, but began to roll over there for a 34% decline. Spiked up 25%, back down 20%, up 24%, ultimately down 15% before it bottomed in March of 2003. So folks, again, be very, very careful. I said to one friend the other day, if you're a swing trader, I think you're going to have some opportunities, but a swing trader establishes some technical process for guessing when these, you buy here, you sell here, and so forth. So start to finish here, folks, we're talking about virtually 3 years, actually a 30-month ordeal to get through here. And we had the tech bubble bursting. I've been sharing with you for the better part of a year now that we have a credit bubble in the corporate sector. I do think it needs to burst. I think it's going to burst. I think it's in the process of bursting. Anything can happen. The powers that be are desperate to keep that from happening and to patch up the leaks. We'll see if they succeed. So in terms of the length of bear markets past, here we are in the present, not even a month, right? 27% decline, absolutely unbelievable. Here's the 2008 affair, began in October 2007, 17 months for a 57% loss. And these are the two I just showed you. 50%, call it 30%. 3 months, 3 months, 20 months, 20 months, 18 months, 8 months, 6 months, 15 months, 36 months, Great Depression, 62 months. So, and lots and lots of declines in here that would really upset permanently some portfolios. So if we bounce back next week, this will be the shortest bear market in the history of all bear markets, amid the coronavirus, amid the credit problems that I'm seeing, amid the liquidity issues that I just blogged on here a little bit ago. Boy, it just seems so highly unlikely that Thursday spelled the bottom in this market. So if any of you who perhaps aren't clients or maybe play around with some of your other monies, if you feel bad about missing the big bounce on Friday, probabilities suggest that you'll have another another go at it at some point, maybe several more goes at it. So my whole point here, folks, today, and I thought it was important that I jump in and give you some of this, is just please be careful out there. And your clients, I think it's important that I continue to share what we're thinking about conditions and why we're doing certain things and not doing others. I like this illustration, although the line for the market is a lot tamer than it should be. But this is your, leading up to your 2008 experience. We had the Fed rate cut, Bush tax cut after the market began to plummet. There were some rallies in here, but you can see for the most part, the market continued to plummet. Fed jumped in with an emergency, 0.75% rate cut. They did a 0.5% last week. We had all these housing support programs come online, and then it must have felt like, okay, finally they did something that's going to save us. You can see the market came up, lower high. Now equities are in a bear market. That's your 20% decline. Happened, took some time, as you can see, several months, not several days as this one. Then you had Lehman, AIG, Washington Mutual, Freddie and Fannie just basically go belly up. First they failed, and they turned right around and passed the TARP, coordinated central bank activity. TARP was huge. You went to zero interest rates in the U.S. And of course, quantitative easing programs, all before the market finally bottomed. Of course, all of those would be reasons to buy. The reason to buy on Friday was just the promise of a coronavirus bill to provide support for folks in need and for the economy ultimately. And so all through all those attempts and all those reasons to buy, the market still dropped actually 57% during that time period. So folks, again, just some history that says you want to be careful out there. Last but not least, our own back testing of our own index. So I didn't load up the chart or the graph of the index, but what we do and what I do every single week is score dozens of data points on an index. We have a macroeconomic index, we have a financial stress index, we have a financial markets index, fear gauge, and so forth. But the macro index is the one that counts, and I developed that right back here in mid 2017. And we got our first real-time red score right back in here in around the summer. We had 5 or 6 weeks. We began to hedge portfolios right here, came into the green for a few weeks, and now we're in a negative 23. The market has something to do with that, but again, we have a separate one for financial markets that's obviously not looking great either. Our financial stress index is maybe the one that concerns me the most. I'll probably share more of that with you at a later time. But folks, so here we have in our view, macro conditions rolling over. 21st straight week, I believe, in the red. Not a good signal. So why do we take this so seriously? Well, you may recall that back here in 2018 when the market was falling, we were sanguine and we expected this market to come back. I showed you lots of charts of history. I was using this one back here in 1998 as a good example, a similar degree of decline. Our index was still scoring pretty nicely in the green, right? Same thing here. In fact, highest ever score. This 10% decline here was utterly meaningless to us. Back in here, now I wasn't scoring the index, although we were crunching a lot of data. We kept clients engaged in the bull market there. European debt crisis, we got close, but not all the way. So these were all good experiences, good times to stay the course, maybe buy the dips in the longest ever bull market in history. What changed my sentiment, along with other things too, other technical factors and so forth, was the fact that the macro was rolling over. Right up in here, even in here, I still hear people saying we have a great economy. Well, I've shown you this, ad nauseum. Consumer economy still looks pretty good. The industrial economy, utterly, absolutely, however you want to say that, has not, does not, and it's getting worse by the day, of course, right now. You go back here in the early 2000s, you can see where our index rolled over on a back-tested basis. When I have clients in the office and I show this, I always tell them when we have this, here's a minus 36 right before this one, expect the market to rally because all this stimulus is going to come in, because even though they're going to be talking up the economy as something wonderful, the Fed is going to be stimulating and the government's going to be cutting taxes or whatever, because they are getting the clue that things aren't good. In fact, there's some fragilities, and of course they always want to keep the next recession from happening. So stock markets love that. We can't afford to be super growthy in a fragile environment. So it's tough. It's got to be tough for clients. Invest my own money just the same way I do my clients. And so we all, would have missed out here and absolutely missed out on a really nice run here. Of course, we just took back all of that missing out, at least for the moment. Of course, we could come snapping right back and some, and we're getting close to this bottom right in here. So folks, this really, of all the rambling I've done today, this speaks really more to why I'm not really crazy right here about buying the dip as the market clears the excesses of 11, 12 years of growth. I'll leave it there, a little longer than I expected, but thank you for watching and listening. Much more to come. Take care. Bye.